Good morning, everyone. Today we have two topics for our discussion. One is professional and ethical duty of a chartered accountant, followed by the conceptual framework. So, the professional and ethical duty, we will be focusing on the code of ethics, fundamental principles, and the framework that is applicable to all the chartered accountants. And the more important one is the code of ethics that is relevant with the chartered accountants in service and practice, and thereafter realize the implications of the various schedules. While a part of this is forming a major portion of what you would have been studying under the advanced auditing paper, we will be taking you through some of the case studies which are pertinent to members who are in service, where we look at how certain real life examples and cases does make an impact on the ethical responsibilities that members in service have to fulfill. What are the pillars on which the professional ethics stands? So, we have the Code of Ethics, we have the Chartered Accountants Act 1949, the Council guidelines, and recommended self regulatory measures. So all of this comes by virtue of membership to the institute, which is for both the members in practice as well as in service. So when you talk about the misconduct, it could be professional as well as other misconduct. And we have the first and the second schedule to the act that deals with this. You would have studied it in your advanced auditing paper. So when we talk about ethics, the code of ethics was made the revised code of ethics was made applicable from 1st July 2020. So it sets out fundamental principles of ethics for chartered accountants who are normally known as accountants in common parlance. So that is what we are going to focus on in today's discussion. Then you have the Chartered Accountants Act provisions, which defines what do you mean by professional or other misconduct. So that is a part of your audit paper. Will not be covering much of that in detail. So you could refer it in your auditing paper. Coming next to the complying with the code, we have fundamental principles. We have 5 fundamental principles that we have to comply with. The first one is integrity, that is being straightforward and honest in all professional and business relationship. The second one is objectivity, that is not to compromise professional or business judgments because of bias, conflict of interest, or undue influence of others. So typically, you would be having certain scenarios where a bonus that is payable to the top management is dependent on revenue, or it could be dependent on the gross margins, or it could be dependent on the EBITDA margins. So in all these cases, there is a strong incentive for the results to be presented in a manner that enhances the incentive that will be paid out to the business unit heads. Like, they may be recognizing revenue before the goods are shipped, before the obligations are fulfilled in line with India's 115. So in all these scenarios, more the revenue, more will be the bonus. So therefore, our responsibility both as preparers of financial statements as well as if we are on the other side as auditors of these financial statements, it becomes crucial for us to understand those activities or those incentives which create a bias on the preparation of financial statements. Additionally, what could happen is you could be having certain undue influence. Like, for example, they may threaten the accountant with the job. They would say that you need to present these numbers in a particular fashion, otherwise, you will not be getting the incentive. So, these are all coercive methods of putting it on the members who are engaged in preparation. So that is also something that we need to look into. Coming to the next one, professional competence and due care. Basically, this is ensuring that we remain competent enough and we have our knowledge and skills updated at all times and to act in accordance with the technical and professional standards. So that is something which we are expected to have. Okay, so this is in accordance with applicable technical and professional standards. Confidentiality, to respect the confidentiality of information acquired as a result of professional and business relationship. So that is what we are expected to have. And finally, professional behavior, comply with laws and regulations and avoid the conduct that is not befitting a chartered accountant. And what is the fundamental takeaway from here is a CA shall comply with each of these fundamental principles. This is the key one that we have. All right. Coming next, they may face a situation where complying with one fundamental principle conflicts with complying one or more fundamental principles. Like, for example, suppose there is a requirement where you are obligated to give certain information to regulatory authorities. That is expected from you. But it is possibly conflict with the principle of confidentiality. So if that is the case, how do we go about? Chartered accountant might face a situation. So if that is the case, you would have to consult others within the firm, those charged with governance, the institute, or legal counsel. However, what is important to know is the consultation does not relieve you from the professional judgment to resolve the conflict unless prohibited by law or disassociate from the matter creating the conflict. Coming to integrity, comply with the principles of integrity, which requires an accountant to be straightforward and honest in all business relationship. Objectivity, so we comply with objectivity, which requires accountant not to compromise because of bias. So we have an illustration in this regard. Infostar is a listed company. The directors are paid a bonus based on profits achieved by the company. So in these cases, the intention will always be to report more profits. And there are numerous ways in which profits can be presented. There are numerous ways in which profits can be presented by virtue of, altering certain estimates, putting in certain matters which are not easily detectable, but they do create a higher profit. So that those are all the situations where you can have the profits that will flow in. So the range of profit, if it is less than 1 crore, bonus to directors is 0. If it is 1 to 5 crore, it is 2% of NPAT. If it is 5 to 10 crores, it is 4% of net profit after tax. So these are the slabs which are given. The draft statement of P&L for the year shows a profit of 2 crores. So this is where the current slab is fitting. So the directors are getting a 2% incentive if these are the financial statements. Now, on 25th March, Infostar sold land located adjacent to its head office for a consideration of 40 crores with an option to purchase the land back on 25th May 20x2. So just within 2 months for 40 crores plus a premium of 6%. So they have entered into an agreement where today I sell for 40 crore and I will buy back from you for 40 crores plus 6%, and the gap is only 2 months. Amount received from the transaction eliminated the bank overdraft of Infostar. On instructions of the chief financial officer, the transaction was treated as a sale, including the profit arising on disposal in the P&L for the year ending 31st March 20x2. So discuss the ethical and accounting implications. Now, I made a profit on this transaction. This profit is forming part of the profit that is 2 crores sitting in the financial statements. Now, does it meet the conditions specified in Ind AS 115? Yes, the sale of land meets the conditions specified in Ind AS 115 for qualifying as a repurchase agreement. So whatever conditions are outlined, they are met. And therefore, the control is actually not transferred. What it should be is, it is nothing but a financing arrangement. And when we talk about a financing arrangement, the 6% premium that you are paying is nothing but a finance cost. What should have been done is, they should not have de-recognized the land because the risks and rewards are not transferred. The substance of the transaction is a loan of 40 crores with an interest of 6%, that is your finance cost. Recording this is an attempt to manipulate the financial statements to show an improved profit and a more favorable cash position. So ideally, what you should be doing, reverse the sale, reinstate the land, and the profit should get eliminated. Now, Coming to the ethical issues, you are expected to comply. So it appears that integrity of the CFO is compromised as he has accounted the transaction as a sale. It is only the impact is only to improve profits, eliminate the bank overdraft, making the cash position seem better than it actually is. This is nothing but window dressing, which is not honest. Also, act with objectivity. Management must put the interests of company and the shareholders. The pressure to show profits and achieve the bonus is in the self-interest of the directors. That is important. Seems to have been partly driven the transaction and the subsequent accounting, which is clearly a conflict of interest. Further, necessary to comply with the principles of professional behavior, which require compliance with relevant laws. It is not in conformity with Ind AS. So the answer that we are expected to give is a very, very comprehensive answer where all the points are covered in detail. So it also takes from it also expects from you an understanding of the Ind AS principles that you would have studied as part of the program. And once you have studied that, you need to apply those principles in framing your answer. And the non-compliance of that is also leading to a violation of the professional ethics. So we need to connect the dots backward based on what we have studied so far as part of this curriculum. So here what they are saying, he has not complied, so probably he is not aware. So he has violated the principles of professional behavior. If he is aware but still has applied incorrect treatment, then it is not in compliance with professional behavior. So if he is not aware, then the principle of professional competence is in question because his knowledge and skills would not have been updated. So he is subjected to professional misconduct under this clause. Yeah, so that's it. Who is an employee shall exercise due diligence and shall not be grossly negligent in the conduct of his duties. So this is the way your answer should be presented. A very, very holistic answer to the question that is already there. Coming to the next one, professional competence and due care. It requires a continuous awareness and understanding of relevant technical, professional, and business developments. We live in a pretty dynamic world where we have amendments on tax laws, direct and indirect. We have amendments on reporting standards. We have amendments on customs, foreign trade, etc., which impact the operations significantly. And therefore, it is very important that we continue to remain updated with what we are dealing with. So, continuing professional development enables a CA to develop and maintain the capabilities to perform competently within the professional environment. Okay, coming next, so we have another illustration. Rustum Limited, company engaged in oil extraction, has an obligation to dismantle the oil rig installed by it at the end of a useful life of 10 years. Rustum cannot cancel the obligation or transfer it. So it intends to carry out the dismantling work itself, estimates the cost to be 100 crores at the end of 10 years. Directors of Rustum are aware of the requirements of Ind AS 37 as well as Ind AS 16. So what they are saying is, what does Ind AS 16 tell us? Ind AS 16 tells us that we have to capitalize this provision at the present value. And you will have to start unwinding the discount so that at the end of the 10th year, it reaches the value, it grows to the value that you expect to pay out. And the unwinding of the discount will be presented as a finance cost, and the initial present value of the provision which you would have added to the cost of the asset would get depreciated over the useful life of the asset. The directors are aware of this. However, they propose to expense the cost of dismantling the oil rig as and when incurred, with no entries or disclosures in the financial statements. They argue that application of Ind AS involves judgment. And although prudence is mentioned in the conceptual framework, it is only one among the many ways of achieving faithful representation. Discuss whether the directors are acting unethically in this instance and what should be the chartered accountant's course of action in this regard. Is the treatment in line with the standards? Answer is no. because the standard wants you to capitalize the present value and depreciate and unwind the discount on the provision so that it grows to the value you estimate it to be, and then you do a payout at the end. So the standard wants you to have absorbed the impact over the entire 10-year life. But here the directors are saying they want to expense it out only when it is incurred. So for 9 years, there won't be any impact. In the 10th year, you will have a sudden hit of 100 crore. And they do not want to make any disclosure also. So in this case, it appears to be a deliberate intention to contravene Ind AS 60 and Ind AS 37 and not an unintentional mistake. So though the directors can exercise strong or undue influence, the chartered accountant is bound to act with integrity and remain unbiased, recommending to the directors that Ind AS 16 and 37 must be complied with and ensure appropriate entries are cast in the financial statements. So the matter could be raised before the independent or non-executive directors. You should inform those in governance about the corrective measures. So by doing so, he upholds the fundamental principle of professional behavior, demonstrates compliance with relevant laws and regulations. By communicating, he can ensure that the contravention could be rectified. If he does not communicate, important point is if he does not communicate, then there is a breach of professional behavior principle. Members should comply with the laws and regulations. By knowingly allowing, the chartered accountant would not be acting diligently in accordance with applicable guidelines, subjected to professional misconduct under these clauses. So what are these clauses? Guilty of professional misconduct when he fails to disclose a material fact known to him which is not disclosed in the financial statements, but disclosure of which is necessary in making such financial statements where he is concerned with that financial statement in a professional capacity. Clause 6 fails to report a material misstatement known to him to appear in a financial statement. And finally, guilty of misconduct when he does not exercise due diligence or is grossly negligent in the conduct of his professional duties. So a very beautiful way in which your answer gets presented in a very holistic manner. Confidentiality, you are expected to comply with this principle either as a practicing chartered accountant when you come to know of certain information, or as a member in service when you are already aware of that information by virtue of your employment with the organization. Many times it could be possible that inadvertently you disclose. You may not be having the intention, but you inadvertently disclose the information that you would have, including in a social environment. So what the ethics says is that even in social, when you're socializing with your friends, colleagues who are working for competitor organizations, inadvertently also if we make any what you can say, any disclosure of data which we should not have done, then that amounts to a breach of this principle. To a close business associate or an immediate or a close family member as well, maintain confidentiality of information within the firm or employing organization. Maintain confidentiality of information disclosed by a prospective client or employing organization. Not disclose confidential information acquired without proper and specific authority unless there is a legal or a professional duty or a right to disclose. So not use confidential information for the personal advantage of the accountant or the advantage of a third party. Not use any confidential information either acquired as a result of professional or employment relationship after the relationship has ended. So it extends well beyond the employment or consultancy relationship. Even after the relationship ends, you are not supposed to disclose that information, saying that now I have no relationship with that organization. Take reasonable steps to ensure that personnel under the accountant's control, they respect the accountant's duty of confidentiality. So we are not only responsible for ourselves, but the subordinates who are working for us, they should also be mindful of this principle of confidentiality. It is a paramount ethical principle. It should not be breached when providing payroll services to clients unless required by law or authorized by the client. CAs have a duty to uphold the confidentiality of payroll related information and ensure security and protection of sensitive data of the organization. So in many cases, we have consultancy firms who take over the entire payroll as a processing at the back end. So they process the salaries, the provident fund, social security contributions. They ensure compliance with all the requirements of these acts. For the company doing the business, it is a compliance. If they don't do, if somebody else doesn't do, they would have to do it. So they would be happy to offload this work. Now, when you offload this work to a professional organization, what happens is the salary data, sensitive data of each individual becomes known to everybody. Therefore, they have to be very, very careful when they are engaging in such assignments. Confidentiality serves the public interest because it facilitates free flow of information from the chartered accountant's client or employing organization to the accountant in the knowledge that the information will not be disclosed to a third party. However, following circumstances you may be expected to disclose, like for example, in the course of legal proceedings, disclosure to appropriate public authorities of infringements of the law that come to light, permitted by law and authorized by the client or the employing organizations. Professional duty or right to disclose when not prohibited by law for the purpose of peer review or quality review of the institute, investigation by a professional or regulatory body, protect the professional interests of a chartered accountant, comply with technical and professional standards, including ethics requirements. Breaches of confidentiality may occur, like, for instance, insider trading, not permitted to do. So, when key information is going to be published and you are aware of it, you are not expected to do any insider trading. Hiding material facts which require a disclosure, like reporting fraud, illegal activities, non compliance, does not constitute confidentiality. So, you could probably take a stance that I will not report a fraud because if I report it, it will amount to breach of confidentiality. The law says that that is not the scenario. They have an ethical duty to report fraud or manipulative activities that could impact the end users. So that is all about confidentiality. Coming to professional behavior, the chartered accountant shall not bring the profession into disrepute. A CA is required to conduct his affairs in a manner that he remains outside the boundaries of professional and other misconduct. So you shall not make exaggerated claims for the services offered. Like, for example, you should not say that we are the number one firm to provide audit services or number one consultancy firm or better than the best. Those kind of statements is not permitted. These are prohibited. You cannot make exaggerated claims or the qualifications or experience of the accountant. So all these things are not required. Disparaging references or unsubstantiated comparisons to the work of others. So you cannot pinpoint others and say that we are better than this, or those kind of statements are discouraged as far as it is there. And finally, uh, any direct or indirect measures to advertise any professional or other facts which are in violation of advertisement guidelines issued by the council issued by the council uh, of the institute from time to time. Okay, so is there any doubt so far? Anybody? Yes? Any doubts? Yeah. Anyone? I hope we are able to understand. Yes, all right, fine. So that takes you through all the five principles. The conceptual framework to identify, evaluate, and address threats to compliance with the fundamental principles. Those five are the fundamental principles. Okay. Identify threats. So to compliance, evaluate threats identified, address the threats by eliminating or reducing them to an acceptable level. Okay, so exercise of professional judgment, reasonable and informed third party. So chartered accountants of in service. So we look at conflicts of interest. They could include, one is you are serving in a management or governance position for two employing organizations, acquiring confidential information that might be used by the chartered accountant to the advantage or disadvantage of the other organization. Number one. Second example is undertaking a professional activity for each of the two parties in a partnership where both parties are employing the accountant to assist them to dissolve their partnership. So obviously, this creates a conflict of interest. Preparing a financial information for members of management of the accountant's employing organization who are seeking to undertake a management buyout. Responsible for selecting a vendor when an immediate family member of the accountant might benefit financially from the transaction. Serving in a governance capacity in an employing organization that is approving certain investments for the company, where one of those investments will increase the value of the investment portfolio of the accountant or an immediate family member. So that is your examples of conflict of interest. So the first step that is there is identification of the conflict. So you shall identify the relevant interests and relationships as well as the activity and implication for relevant parties. Typically, the conflicts of interest will create a threat. They could create a threat to the member, and more likely, the level of the threat would not be at an acceptable level. Example of an action that eliminates the threat is you can withdraw from the decision making process related to the matter giving rise to the conflict of interest. Disclosure and consent. It is generally necessary to disclose the nature of conflict of interest and how threats were created, including to the appropriate levels within the employing organization. Obtain consent from the relevant parties to undertake the professional activity when safeguards are applied to address the threat. In all scenarios, it is not necessary that withdrawing itself is a safeguard. In many cases, it could be a case that you could apply other safeguards to reduce the threat to an acceptably low level. And once you have done that, you are free to carry on the assignment. So even in questions, when you are expected to give answers to such situations where conflict of interest is there, do not ever jump to the conclusion we withdraw from the assignment and close it. If we withdraw from every assignment, then how are we going to run the show? Yes, so there will always be certain situations in real life, in practical life also, where conflicts of interest could be there. But we as members, as professional experience, we have to ensure that we apply safeguards that reduce the threat to an acceptably low level. So your answer must bring forward these thoughts. How you could have certain steps taken to reduce the threats to an acceptably low level. If that is not possible, then you can withdraw from the engagement. That's perfectly fine. But just jumping to the conclusion is not right, in my opinion. So Alap Limited's directors feel that the company needs a significant injection of capital to modernize plant and equipment, as the company has been promised firm orders if it can produce goods of international standards. Current lending policies of the banks require prospective borrowers to demonstrate strong projected cash flows coupled with a debt service coverage ratio exceeding 10. Current projected statement of cash flows does not satisfy the bank's criteria for lending. However, the directors have told the bank that the company is in an excellent financial position. The results and cash flow projections will meet the criteria, and the CA will submit a report to this effect shortly. The CA has recently joined the company. it has openly stated, and he has openly stated that he cannot afford to lose his job because of financial commitments. So this is where you start getting trapped. This is where you start getting trapped. He would probably have purchased a house for himself. He would have purchased a vehicle for himself, and therefore he is bound by financial commitments. And because he is bound by financial commitments, a job becomes very important for him to ensure his financial commitments are met. And because the job becomes very critical for him, there will be pressure on him to meet a particular uh, guideline that has come from the top. In this case, presentation of financial statements in a manner more favorable than what the actual position is. So these are the conflicts which we have. So now the first one is pressure to obtain finance and the chartered accountant's personal circumstances. So the CA is under a pressure to provide the bank with a projected cash flow that will meet the bank's criteria, when in fact the actual projections do not meet the criteria. So in this case, and second one is the chartered accountant's financial circumstances mean that he cannot lose his job. Thus, the ethical and professional standards are at odds with the pressure of his personal circumstances. Duty to shareholders, employees, and bank. Directors have a duty to act in the best interest of the company's shareholders and a duty to present fairly any information the bank may rely on. However, here they are going and presenting misleading information. So if the financing is obtained based on misleading information, it could actually be detrimental to the going concern status of the company. So that is how it is going to be viewed. It could be argued that there is a conflict between the short-term and medium-term interests of the company and its long-term interests, the detriment to the company's reputation if the directors do not conform to ethics. Ethical principles guiding the CA's response. Number one, you have to comply with the principles of objectivity, integrity, and professional competence. By exhibiting bias due to the risk of losing his job, clearly objectivity stands compromised. Integrity is also compromised because you are giving incorrect information knowing it to be incorrect. Forecasts do not specify that they have been prepared in accordance with Ind AS. So therefore, they are just projections. And you are free to do that in the way you want. It is after all an Excel sheet. In an Excel sheet, you can manufacture profits the way you want. So therefore, you are compromising with objectivity, with integrity. So that professional competence, these are just projections. It requires the accountant to prepare cash flow to the best of his professional judgment, which would not be the case if the projection showed a more positive position than what is actually anticipated. So he faces an ethical dilemma. If he complies with the ethical principles, he loses his job. If he wants to keep his job, he has to sacrifice the ethics. So these are what we call in common parlance as ethical dilemma. And we as professionals, whether we are in practice or whether we are in service, whether we are employed or whether we are into consultancy, whether we are an auditing firm or whether we are back-end support to the organizations, there are innumerable instances that we come across ethical dilemmas. We have to rise over and go for a step that ensures we comply with the ethics. Okay. So the chartered accountant should put the interests of the company and professional ethics first and insist that the report be an honest reflection of the company's current financial position. Being advisor to the directors prevent deliberate misrepresentation, no matter what the consequences to him are personal. Thus, the accountant should not allow any undue influence from the directors to override his professional judgment or integrity. This is in the long-term interest of the company and its survival. So communicate to the directors should communicate to the directors to submit the projected statement which reflects the current position of the company. See, in future, you cannot merely project high revenues. You have to give a justification for that. If you are saying my revenue increases 50% year on year, You need to back it up with data. Like, for example, a firm order book, or you have made a bid and you have met the technical criteria and you expect the financial criteria also to be met. So they should be backed by some strong evidence. If that evidence is not there, you merely cannot say that I will get a 50% increase in revenue in the next year. However, if he submits the incorrect, okay, so providing incorrect information is professional misconduct. So CA should not provide incorrect projected cash flows and color the financial position of the entity. If he submits the incorrected projected statement of cash flows, he would be subject to misconduct under clause 1 of part 2, which states that any member, whether in practice or not, shall be deemed to be guilty if he contravenes any of the provisions of this act or the regulations made thereunder. And what the guidelines say, member who is in employee shall exercise due diligence and shall not be negligent in the conduct of his duties. So this is what is your ethical dilemmas. Okay. Preparation and presentation of information present in accordance with the reporting framework, neither to mislead nor to influence contractual or regulatory outcomes, represent the facts accurately and completely, describe the true nature of business transactions, clarify and record information in a timely and proper manner, do not omit anything with the intention of rendering the information misleading. Use of discretion. The chartered accountant shall not exercise such discretion with the intention of misleading others or influencing contractual or regulatory outcomes inappropriately. For example, determining fair Ind AS is a beautiful framework, but it has lot of estimates, lot of positions that you take just because it allows us to take. For instance, you would have studied Ind AS 115 that deals with revenue. So there, a variable consideration can be factored into the consideration expected to receive if you are fairly confident of meeting the targets, like an incentive for early completion of a project. The standard says, fine, if you believe you can complete the project before the deadline, then take that into your consideration and proceed. It does not require you to be very conservative and say, I will recognize that incentive only when I receive it. You would have studied this when you would have done Ind AS 115. So now this is a classic example of how we can overstate our profits. Because today, whether I have the information or not, the member can always say standard tells me, and we are doing this project for so long, so we have the capability to complete within the specified period, so we become entitled to the incentive. This is something that the member will automatically jump to a conclusion. Those kind of situations must be avoided. So you would have to be very careful when you are manipulating an estimate. See, so therefore the role of third party auditors becomes critical, because here they have to question the basis on which you have done that estimate, right? Secondly, another example, Ind AS 19, employee benefits, leave encashment, right? So an employee has taken 13 days leave. Instead of 10 days leave that is granted, he has taken only 7 days, and 3 days get carried forward to the next period. So now, how much will he utilize in the next period? 1, 2, or 3 is an estimate that you make. Based on your estimate, the cost will be booked in the current year. So you can always say, I don't think he will utilize it in the future. So therefore, current year, I will book a cost only of 7 days and not of 10 days. So you are minimizing the cost and improving the profitability. So in all this, and next year, if he takes those 3 days extra, 10 plus 3, he takes 13 days. You will put the cost in the next year and say that I thought he would take, he did not take. It is a change in estimate for which prospective treatment is permitted. For one employee, this will not be a problem. But when you have thousands of employees in your company and सबके leave में से when you remove 2 to 3 days, it will become a sizable chunk which can add directly to your bottom line. And this happens only because of estimation, right? So that is one thing that you have. Another example, Ind AS 109 requires you to present investment in equity instruments at fair value. Now, fair value can be determined by reference to the market values, the fair value hierarchy, what we saw, level 1 input, level 2 input, level 3 inputs. Level 3 inputs is purely biased. You will apply those principles, you will estimate the cash in the future, discount them to present value, and give the value of the share. Whereas level 1 tells that observable inputs, whatever are there, you straight away take that and do not apply your estimates or bias. So now in this case, when you have level 1 inputs, you should not go through level 3. Level 1 input is the best representative because it is a market value representative. And therefore, in the determining the fair value estimates, you have to be very careful. So this is one area where you can expect what you can say, where you can expect incorrect reporting. Okay. Selecting or changing an accounting policy among two or more alternatives permitted. For example, selecting a policy for accounting for long-term contracts in order to misrepresent profit or loss. Determining the timing of transactions, sale of asset near the end of the financial year in order to mislead. We saw that example. Determining structuring of transactions. For example, structuring financing transactions in order to misrepresent assets and liabilities or classification of cash flows. Selecting disclosures. For example, omitting or obscuring information relating to financial or operating risks in order to mislead. When performing professional activities, the CA shall exercise professional judgment to identify and consider the purpose for which information is to be used, the context within which the information is given, and the audience to whom it is addressed. So this is one of the things, that is use of discretion. Relying on work of others, either internal or external, shall exercise professional judgment. What will you look into? The reputation and expertise of the other individual or organization, whether he is subject to applicable professional and ethics standards. Addressing information that is or might be misleading, take appropriate actions. What are the actions the chartered accountant can take? Discussing concerns that the information is misleading with the superior and or appropriate levels of management within the employing organization. It could include having actions could include having the information corrected, or if it is already been disclosed, informing them of the correct information. Consulting the policies and procedures of the employing organization. For example, ethics or whistleblowing policy regarding how to address such matters internally. The chartered accountant might determine that the employing organization has not taken appropriate action. And if he continues to believe the following actions become relevant, of course, keeping in mind the principle of confidentiality, that is, consulting with the institute, internal or external auditor of the employing organization, and legal counsel. Determining whether requirements exist to communicate to third parties or regulatory and oversight authorities. You have to be very careful when you take such suo motu steps, because the principle of confidentiality could possibly end up getting breached. So you can go through this question for homework. Yes, illustration 4, fairly simple. Yes, all right. Next, acting with sufficient expertise. So a self-interest threat. So a chartered accountant shall not intentionally mislead an employing organization as to the level of expertise or experience that is possessed. Many times to seek the job, we promise more than what we actually have as part of our skill set and our education qualifications. Okay, so you shall not do that. A self-interest threat shall be created if a chartered accountant has insufficient time for performing or completing the relevant duties. And believe me, this is a common phenomenon like ethical dilemma that we face. And I believe that many of you would have faced this particular situation also. There is insufficient time. You are filing a tax return on behalf of your client, and your client has come on 30th July with the data, and you are expected to file the tax return. Insufficient time for performing or completing the relevant duties. Same goes for the audit season. incomplete, restricted, or otherwise inadequate information for performing the duties, insufficient experience, training, and or education. So this is where our articleship makes, I mean, it plays a very significant role, because when we are into the job market, or when we are into the post qualification scenario, it is your articleship and what you have done in your articleship that will ensure that you have at least some form of experience. Thereafter, where you want to go is something that you have to take a call. And inadequate resources for the performance of those duties. So how can you override these threats? How can you, I mean, how can you not override? How can you apply safeguards for these threats? Obtain assistance or training from someone with necessary expertise, ensuring there is adequate time available for performing the relevant duties. If a threat to compliance cannot be addressed, determine whether to decline to perform the duties. If the accountant determines that declining is appropriate, the accountant shall communicate the reasons. Okay. I want you to go through this as homework. It's regarding change in the entitlement of pension from 12 to 18.5%, and they want to take it. They want to take it to the other comprehensive income instead of the P&L. This is not. This is not what you can say. This is not a demographic change or change in actuarial assumptions. This is a change that is giving rise to a past service cost as well as implication in the current scenario. So it should go to the P&L. It should go to the P&L. You are modifying the plan itself. So taking it to the other comprehensive income would not be right. So you can read this solution in detail. Okay. Financial interest, compensation, and incentives linked to financial reporting and decision making. We have discussed this at length. So you should ensure that your financial statements are not ensuring you report the numbers more than they actually are. Okay. Like, for example, manipulating price sensitive information to gain financially, holding a direct or indirect financial interest in the employing organization, and the value might be directly affected by decisions made by the accountant. Profit related bonus. Whenever there is a profit related bonus, your eyebrows should go up. You should have queries. Your eyebrows should go up, because there is a chance of earnings management. There is a chance of earnings management. Holds directly or indirectly deferred bonus share rights or share options in the employing organization, the value of which might be affected by the decisions made by the accountant. Participates in compensation arrangements which provide incentives to achieve targets or to support efforts to maximize the value of the employing organization's shares. So I leave this illustration 6 for homework, because it's quite manageable. Okay, you can go through this for homework, no doubt. So I think by now, did you get a understanding of what is expected from you? Have you received an understanding of how answers should be presented? Yes. Is there any doubt? Is there any doubt? Yeah. Any doubts? Any queries? Manish? Okay, fine. So with this, let us proceed further. So here you have certain profit. I mean, all right. So you can go through this also for homework. It covers a lot of points which we have already discussed. Inducements, including gifts and hospitality, minor acts of hospitality between business colleagues to acts that result in compliance with laws and regulations. So, an inducement can take many forms, such as gifts, hospitality, entertainment, political or charitable donations, appeals to friendship and loyalty, employment or other commercial opportunities, preferential treatment, rights, or privileges. Okay. So that is done. Responding to non-compliance with laws and regulations in case of employment with listed entities. A chartered accountant might encounter or be made aware of non-compliance or suspected non-compliance in the course of carrying out professional activities. Okay. When responding to non-compliance, the objectives are comply with principles of integrity and professional behavior, alerting the management or where appropriate to those charged with governance to seek to enable them to rectify, remediate, or mitigate the consequences, or deter the non-compliance where it has not yet occurred. Deter means stop the non-compliance, and to take further action as appropriate in the public interest. So you can go through this. All right. Responsibilities of all chartered accountants in service addressing the matter when further action is needed, seeking advice, whether to disclose to the appropriate authority and responsibilities other than senior chartered accountants. So you can go through this question as homework. Yes. All right. Pressure to breach the fundamental principles cannot work. Okay. Fundamental principles, uska naam hi fundamental hai. Okay. The name itself is fundamental. Breach cannot be acceptable under any circumstances. Okay. Those five principles are the fundamental principles. Okay. So go through this for homework. Uh, yes. All right. So fair enough. That kind of closes the whole topic. Yes. You can cover this one question in your test your knowledge section. Yes. So that's it. That's about it. Okay. So that concludes our discussion on professional ethics. So what is important is you have attained a level where you have a mature understanding of the provisions of Ind AS. You are fairly conversant with the schedules under the Chartered Accountants Act, uh, that is applicable in the case of misconduct. And you are also conversant with the code of ethics that is applicable to members in practice as well as in service. When you get a question, you have to marry all these three things together. You have to join all these three things together and present your answer in a very, very comprehensive manner. Only when you present it in a comprehensive manner by eliminating all possibilities of a debate, only then can you go ahead and do the justice to the question that is asked. It is a very scoring chapter, easy to understand. It is just application of ethical principles, right? So you need to make sure you are familiar with the pattern that is asked. Yes, it will largely be a case study oriented question for this chapter. They will not ask you straight away what list the five fundamental principles. No, but your answer, which is the which would be in response to the case study asked, should always refer to the five fundamental principles, whatever is applicable to you in that particular question. Because in all the questions, there will be a breach of the fundamental principles. You, as the student, have to identify what is getting breached, what are the safeguards to prevent it, and if there is no safeguard, then is coming out of the assignment the only option available. That is how you will have to present your answer. Are we okay with this? Yes. Are we okay? Any doubts? Okay. Just give me a minute. So with that, we conclude our discussion on professional ethics, and we shall move on to the next topic for today's discussion, that is the conceptual framework for preparation and presentation of financial statements in line with Indian accounting standards. This is a precursor to your Ind AS, but typically we either do it before or at the end. At the end, if you do it, the advantages, you know everything about Ind AS, so we will be able to correlate. If you do it before the Ind AS, the advantages that you know what is expected from the framework and you can apply it. In all the situations, studying this topic is advantageous. Okay. So what do you understand by a financial reporting framework? We run through this topic. Okay. So statement of generally accepted theoretical principles which form the frame of reference for a particular field of inquiry. So financial reporting framework forms the basis for determining which event should be accounted. That means what should I do, how to measure, and how to communicate. These are the three things that is the basis for any reporting framework. In relation to Ind AS, you have to remember one thing: framework itself is not an Ind AS. It is a guideline for drafters, for standard setters, but it is itself not an Ind AS. It does not define any standards for any particular measurement or disclosure issue. So, in any of the paras in the conceptual framework, you will not find reference to measurement, recognition, disclosure, all these principles, derecognition, all these principles you will not find in the conceptual framework. Framework does not override any specific Ind AS. In case of conflict between Ind AS and the framework, Ind AS requirements will prevail. So fairly simple. What is the purpose of the framework then? The purpose of the framework is to assist ICAI in formulation of Ind ASs that are based on consistent concepts, assist the preparers to development consistent accounting policies when no Ind AS applies to a particular transaction or event, or when an Ind AS allows a choice of accounting policy. So even today, there are certain cases where you are not having an Ind AS guideline for certain transactions. So when there is no guideline for certain transactions under Ind AS, we come to the conceptual framework to see how to do the accounting of that. And all parties assist all parties to understand and interpret the Indian accounting standards. So these are the objectives and the concepts for general purpose financial reporting. What do we have as the objectives of general purpose financial reporting? To provide financial information which is useful to existing and potential investors, lenders, as well as other creditors. So these are the persons who are going to make decisions relating to provide resources to the entity. Correlation between the general purpose financial reports and decision making process. Financial information about the economic resources, that is your assets, claims against the entity, that is your liabilities, and changes in those resources and claims, that is your operational statements. Assessment of amount, timing, and uncertainty of future net cash flows to the entity, and stewardship of the entity's economic resources. Expectation of returns, all of these things put together will give rise to decisions of investors, lenders, and other creditors. Limitations: it cannot provide all the information that potential investors, lenders, and other creditors need. Like, for example, if you are undertaking an investment exercise, your investors will not only look at past data, they want to know how the things will pan out in the future. What is your next 5 years estimate, next 8 years estimate? How will the material costs go? What will be the escalation? Are you covered for that escalation? Do you need extra facility? Do you need additional capex? What is the amount of capex you need? How are you going to fund it? What is your current loan status? Are you going to repay the loans? What is your current ratios? How are we going to improve it? So they need this data year on year. They need this data year on year. And therefore, your information that is provided in general purpose financial reporting, it covers only two, and that also historical. Investors won't be interested in historical. वो बोलेंगे historical was historical. Tell us about the future, because we are investing in your future. We are not investing based on your for your past. Your past and the future, they should properly converge. They should properly converge so that the momentum, the smoothness, the continuity is visible. But general purpose reports do not give this data value. General purpose financial reports not designed to show the value of a reporting entity, but they provide information to estimate the value. So valuation of my shares, that data is not given. But with my financials, value can be computed. Users. It is not directed to other parties such as members of public, regulators, etc., other than investors, lenders, and other creditors. So that takes care of your limitations. So when you talk about what is the financial information that is presented, one is your financial position, which is your economic resources as well as claims, that is assets and liabilities, effect of transactions and other events that change entities' economic resources and claims. We saw this comprehensive income, cash flows, and changes not resulting from financial performance. What to report? We have seen this. Coming to the qualitative characteristics of financial information. One is fundamental characteristics, relevance, and faithful representation. Faithful representation means it should be complete in all respects. It should be neutral. That means you cannot allow bias to influence it. It should be free from error. And enhancing characteristics, comparability, verifiability, timeliness, and understandability. Now I want you to tell me, look at this qualitative characteristics and tell me, do you anywhere see conservatism as a principle? Do you anywhere see conservatism as a principle? We see conservatism as a principle only here, supported by exercise of prudence. But what is key to understand is it is saying neutral. That means don't allow bias to come in your way. Don't allow bias to come in your way. But it does not mean that you be conservative. It does not mean that you do not take the best estimates of certain in certain situations. That is not what it tells us. What it tells us is you remain neutral, but you add a few drops of conservatism to it. Then you are okay. But putting the entire conservatism in a bottle and a little bit of neutrality, that is not what is required or expected from the conceptual framework. Okay. So that is what is these are the qualitative characteristics. So two fundamentals, that is relevance and faithful representation, and four enhancing, that is comparability, verifiability, timeliness, and understandability. What do you mean by relevance? Relevance means information with a predictive value. That means it allows you to make future predictions, or confirmative value. You had made a prediction earlier, now you got the data, so you can confirm what you predicted versus what you have actually achieved. This type of information makes it capable of a difference in the decisions made by users and makes it relevant financial information. So relevant financial information is essentially that information which is capable of making a difference in the decisions made by the users. It has both predictive and or confirmatory value. Consider materiality. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence decisions of primary users. So these are your qualitative characteristics of useful financial information relevance. Okay, you can go through this example for homework. Faithful representation. 3 points: complete, neutral, and free from error. So when we talk about complete, you have to give complete depiction, which includes all information necessary to understand the phenomenon being depicted. That means your disclosures must give a complete understanding of what you are actually trying to present in the financial statements. Absence of bias and or manipulation in the selection or presentation of financial information is what neutrality stands for, supported by exercising prudence. What do you mean by prudence? Exercising caution when making judgments under conditions of uncertainty. And finally, free from error, absence of error or omissions, but it does not mean perfectly accurate in all respects. Process used to produce the reported information has been selected and applied with no errors in the process. So that is how this particular thing looks like. Okay. So for example, when we talk about complete depiction, what do we depict? At minimum, the nature of assets in the group, numerical depiction of all the assets, description of what the numerical depiction represents, cost or fair value, and for some items, a complete depiction may also entail explanations of significant facts about quality and nature of the items, factors and circumstances that might affect their quality and nature, and the process used to determine the numerical depiction. For example, facts such as encumbrance or hypothecation or mortgage of items of PPE against secured borrowing, disclosure of fair value of investment property, etc. The use of reasonable estimates is an essential part of preparation of financial statements. Examples of estimates could include useful life of property, plant, equipment, NRV of inventories, fair value of investments in an unlisted entity, provision for doubtful debts. All these are estimates. As long as the estimates are fair, the financial statements will be concluded to be free from error, even though actual outcome may be different from the original estimate. Are we okay with this? Yes, are we okay? Any doubts? No doubts? Yes, qualitative characteristics, everything clear? Fundamental qualitative characteristics. Is it all clear? Yes. All right, fine. Coming next, applying fundamental qualitative characteristics, identify an economic phenomenon, information of which is capable of being useful to users of the entity's financial information. What is the type of information that would be most relevant? Determine whether that information is available and whether it can provide a faithful representation of the economic phenomenon. If faithful representation is achieved, the process of satisfying the fundamental qualitative characteristics ends at that point. If not, the process gets repeated. Okay. Enhancing characteristics are four. Comparability. You should be in a position to compare with similar information about other entities and with similar information about the same entity for another period or another date. Coming to verifiability, it means that different knowledgeable and independent observers could reach consensus that a particular depiction is a faithful representation. Verification can be direct or indirect. That is, checking inputs to a model, formula, or other technique and recalculate outputs using the same methodology. Coming to timeliness, it means having information available to decision makers in time to be capable of influencing their decisions. The financial statements presenting it in the month of September, October is meaningless because we have covered half of the next year. What do I do of the previous results? So typically the audits should be closed ASAP so that we take whatever adjustment entries come out of the audit into the financials. So when we report the first quarter numbers, they already have absorbed the impact of the audit. So that is why timeliness is critical. Classifying, characterizing, and presenting information clearly and concisely makes it understandable. So that is your understandability. All right. So this you can go through for homework, practical applicability. Applying, enhancing qualitative characteristics, you can just go through this for homework. Cost constraint. In all this, there is a pervasive cost constraint. That means the cost to prepare the financials compared to the benefit derived out of it, compared to the benefit out of it, because the questions that we always should ask is, when we have to do some reporting for which we incur certain cost, can we justify those costs by the benefit of reporting that information? That is something that we should always ask ourselves. Okay. Both the providers and users of financial information incur costs in reporting and analyzing financial information. In applying the cost constraint, ICAI assesses whether the benefits of reporting particular information are likely to justify the costs incurred to provide and use that information. Okay, because of inherent subjectivity, different individuals' assessments of costs and benefits for particular items of financial information will vary. Therefore, ICI seeks to consider costs and benefits in relation to financial reporting generally and not just in relation to individual reporting entities. So what is the objective of financial statements? To give information about assets, liabilities, and equity, income, and expenses that is useful to finance users of financial statements in assessing prospects for future net cash inflows and management stewardship of the entity's economic resources. All right. Now, financial statements are ultimately the management's responsibility. What forms part of this? A balance sheet, a P&L, statement of changes in equity, and of course, we now have cash flows. Notes to the financial statements and supplementary schedules and information based on or derived from or expected to be read with financial statements. Example, segmental information, disclosures about effects of changing prices, etc. Reporting period, typically it is for 12 months in India from 1st April to 31st March, and to help users of financial statements to identify and assess changes and trends, provide comparative information for at least one preceding reporting period. Is information about future transactions covered in the financial statements included if it relates to the assets or liabilities or equity that existed at the end of the reporting period? That means adjusting or non-adjusting events in line with Ind AS 10, disclosing future cash flows in computing value in use as per Ind AS 36. These are two examples which are there. Okay. Presentation perspective, they are presented viewed from the perspective of reporting entity as a whole. We are not presenting it from the perspective of one group of users, but it is a generalized form of presentation that we engage in. Going concern assumption is what we always follow. If we do not follow, then that has to be explicitly mentioned. And you mention what is the basis that you are going to use. And of course, the auditor also, in terms of SA 570, is required to comment on the appropriateness of the going concern assumption. So, what do we look at in terms of reporting? If the reporting entity is parent and subsidiaries put together, then that is the consolidated financial statements. If the parent is a single entity, unconsolidated financial statements. Two or more entities not at all linked by parent subsidiary relationship, combined financial statements. At least I have not come across these. Okay, so that concludes the financial statements and the reporting entity. Next, we move on to elements of financial statements. Are we okay so far? Yes, are we okay? Any doubts? Lot of theory. All right. Okay. All right. Fine. So Gapriya has answered. It's okay. Yes. All right. You would like a break now if the theory is a big overdose, or we continue for another 15 minutes and then take a break because the theory continues and we run through some questions and close the topic. I'll need maximum 45 minutes. Okay, we can continue. All right. Fine. Okay, so let us continue. Elements of financial statements. So far, we were talking about the financial statements. Now, what forms part, the building blocks of my financial statements? All of us are aware: assets, liabilities, equity, income, and expenses. So, definitions of asset: a present economic resource controlled by the entity as a result of past events. It is a right that has the potential to produce economic benefits. Liability, a present obligation of the entity to transfer an economic resource as a result of past events. Equity, residual interest in assets of the entity after deducting all its liabilities. Income is something which increases assets or decreases liabilities, which in turn results in an increase in equity other than those relating to contributions from holders of equity claims. A very comprehensive definition about income, and similar for expenses, opposite. Decrease in assets, increase in liabilities that results in a decrease in equity other than those relating to distributions to holders of equity claims. So that is your elements of financial statements. So when we talk about an asset, it is a right, a present economic resource over which you have a right. So rights can be classified into two. One is rights corresponding to obligations of another party, like right to receive cash. A debtor, you have X in your books as debtor. So in X's books, there will be an obligation to pay you. Rights to receive goods or services. Rights to exchange economic resources with another party on favorable terms. Right to benefit from an obligation of another party to transfer an economic resource if a specified uncertain future event occurs. Rights could exist without a counter obligation. Rights over physical objects such as property, plant, equipment, or inventories. Examples are a right to use a physical object or a right to benefit from the residual value of a leased object, right to use intellectual property. Mera hai, it's not anybody else's obligation. So, rights could be established by way of a contract or a legislation, or otherwise than by contract or legislation, what we call as constructive obligations. So, does having a right mandate recognition of assets? Answer is not necessary. All rights are not assets. Like, for example, you have a right to use public roads. So, it is a right without a significant cost. So, you cannot recognize that right to use a public road as an asset. Okay. For instance, rights of access to public goods, such as public rights of way over land, or know-how that is in the public domain, are typically not assets for the entities that hold them. Similarly, an entity cannot have a right to obtain economic benefits from itself. Hence, debt instruments or equity instruments issued by the entity and repurchased and held by it. For example, treasury shares are not economic resources of that entity. If a reporting entity comprises more than one legal entity, that is your consolidated financials, then debt instruments or equity instruments issued by one of those legal entities and held by another shall not be economic resources of the entity. So you remember, in consolidation, we do something known as elimination. Yes. Investment in subsidiary. Does it continue in consolidation or it gets replaced? Yeah. Investment in subsidiary. Does it continue or do we eliminate it? in consolidated financial statements. Obviously, it does not continue. You replace that with the net assets. You replace that with the assets and liabilities. Yes, of the subsidiary. Yes or no? Yeah. Parent has subscribed to debentures issued by the subsidiary. Will you show it in consolidation? Answer is no. Here it is investment, there it is a loan. Both of them will cancel out each other and presented as zero in the consolidated financials. Are we okay with this? Yes. Should each right be recognized as an individual asset? Answer is principally yes. However, for accounting purposes, related rights are treated as a single unit of account. That is a single asset. Example, legal ownership of a physical object may give rise to several rights, including right to use the object, right to sell rights over the object, right to pledge rights over the object, and other rights not listed in A to C. However, generally all the above set of rights arising from legal ownership of a physical object is accounted for as a single asset. As a single asset. All right? Yes? Okay. All right. So we take a 10-minute break at this stage. Yes, we have the next ones, economic benefits and then liabilities, etc. We shall cover. And with that, we would have been done with the topic. So we take a 10-minute break now. We shall convene at 8:30. Yes. Yeah. Is it okay? Break. Break. All right. So let's continue. So when we talk about an asset on the rights and control front and the potential to produce economic benefits, what we are going to look at is the role of probability when we talk about potential to produce economic benefits. So what is important to notice, it does not even need to be certain or likely that the right will produce economic benefits. So we are not looking at certainty, we are looking at a probability. A right can meet the definition of an economic resource and hence can be an asset even if the probability that it will produce economic benefits is low. Although economic resource derives its value from its present potential to produce future economic benefits, the resource is the present right that contains that potential, not the future economic benefits that the right may produce. In case of a purchased option, economic resource is the present right, the right to exercise the option at a future date. The economic resource is not the future economic benefits that the holder will receive if the option is exercised. Role of expenditure, close association exists between incurring expenditure and acquiring assets, but it is not necessary. Example, assets received by way of grants or donations meet the criteria of assets, even though the expenditure is not incurred. Receivable from a customer is a right, from a bankrupt customer is a right, even if the measurement principle renders that the carrying amount of such an asset is nil. You may make a provision, you may make a write-off, but the fact remains that you are still having the entitlement to receive the money from that customer. So asset, an economic resource is linked to the entity by something known as control, What do you mean by control? Present ability to direct the use of the economic resource and obtain the economic benefits that may flow from it. The key takeaway is if one party controls an economic resource, no other party controls that resource. That is the meaning of control. Assessing whether control exists helps to identify the economic resource for which the entity accounts. Example, an entity may have a 40% share in a property without controlling the rights arising from ownership. In such a case, the entity's asset is 40% share in the property, which it controls, and not the rights arising from the ownership of the entire property. What is important is you are able to enjoy the benefits and prevent others from enjoying it. That is the meaning of control. You have your cell phone. You have the right to enjoy that cell phone, the benefits from that cell phone yourself. And you can prevent the others from coming and enjoying those benefits. That is the meaning of control that is implied when we talk about financial statements, assets. Okay. All right. Coming to liability, the entity has an obligation. When we say obligation, there is no practical ability to avoid. There is no practical ability to avoid. It is not even necessary to know the identity of the persons to whom the obligation is known, is owed. It is not even necessary. Provision for dismantling. I will do a dismantling after 10 years. Do I know whom I will engage for dismantling at that point of time? I don't know. But is the obligation present today? Answer is yes. So you have to recognize it in your books. So it's not mandatory for us to know the identity of the person to whom the obligation is owed. It could be one person, it could be one entity, it could be an NGO, it could be a group of people, it could be a society, it could be the world at large. Whatever it is, you have an obligation. Yes, corporate social responsibility is an obligation. If you have not spent a particular amount, the provisions now allow you to carry forward and spend it within a specified tenure. Otherwise, you put it in a fund designated for corporate social responsibility. I do not know to whom I owe it, but I owe it. So I have to make a provision for that. What is the liability? An obligation to transfer an economic resource. A requirement for one party to recognize a liability and measure it at a specified amount does not imply that the other party must recognize an asset or measure it at the same amount. So, see, there are so many things which challenge the fundamental knowledge that we have kept on studying. So, if I have booked a liability at X, it is not necessary that the other party must book an asset at X. Classic example is Ind AS 116. Ind AS 116 that deals with leases. What happens in the case of lease? In the case of lease, the person that is entering into the lease contract, who takes the asset on lease, that person recognizes an ROU asset and a lease liability. What will be the lease liability? The present value of the lease payments that you are bound to pay. Okay, in very simplistic terms. So I have booked the lease liability. But what about the counterparty? Will he have to book an asset? Answer is no. This is books of lesser, books of lessee. So the actual owner of the asset, will he book the lease asset? Answer is in his books, the asset will legally and rightfully belong to him. So he would be recognizing at the cost that he incurred to procure that asset. But will he incur this lease liability correspondingly to the lease asset? Answer is no. For him, it may be an operating lease. He may have given a building on rent to you. The building life is 60 years, out of which you have entered into a contract for 4 years. 4 years, you have to recognize an ROU asset and a lease liability. You cannot take the shelter of a short-term lease. But the opposite party will not necessarily recognize this asset. He will treat it as a regular operating lease income for him, and the asset is already appearing in his books, for which depreciation also is getting charged. So that is your obligation, the meaning of obligation. It's not necessary that your obligation is somebody else's asset. Like in your asset, it need not necessarily need somebody else's obligation. Present obligation as a result of past events. It need not only be legal or contractual. It could also be certain obligations arising from entities' customary practices, published policies, or specific statements. These are what we call as constructive obligations. These are what we call as constructive obligations. Entity has Okay. The entity must have the potential, sorry, the obligation must have the potential to require the entity to transfer an economic resource. It's not necessary, it's not certain also. What is required is there must be an obligation resulting in a potential to transfer an economic resource. That is adequate. Obligation is to transfer an economic resource. We are not again talking about the value here. It could be potentially low value also. Nevertheless, we will continue to recognize it as a liability. Present obligation as a result of past events. Obligation include, for example, obligation to pay cash, obligation to deliver goods or provide services, obligation to exchange economic resources with another party, to transfer an economic resource if a specified uncertain future event occurs. So this is your obligations. Coming to liability again as part of the discussion, entity has an obligation. Instead of fulfilling an obligation to transfer an economic resource to the party that has a right to receive the resource, entities sometimes decide to settle the obligation by negotiating a release, transfer the obligation to a third party. We saw this in fair value, transferring the liability from myself to somebody. In the fair value definition, it is an exit price to sell an asset or paid to transfer a liability. So I'm transferring the liability, or replace that obligation to transfer economic resource with another obligation by entering into a new transaction. The entity has the obligation to transfer an economic resource until it has settled, transferred, or replaced that obligation. So this is what could be the situation. You need not necessarily transfer the same resource mentioned in the initial stages. It could be replacement of the obligation also. It could be transferring the obligation to a third party, or settling the obligation by negotiating a release from the obligation. Present obligation exists as a result of past events only if entity has already obtained economic benefits, or as a consequence, the entity will or may have to transfer the economic resource. Present obligation can exist even if a transfer of economic resources cannot be enforced until some point of time in the future. That is, a contractual liability to pay cash may exist now, even if the contract does not require payment until a future date. A present obligation does not yet have a present obligation if it has not yet satisfied the criteria mentioned. That means it has not taken any economic benefits. Okay. If an entity has entered into a contract to pay an employee a salary in exchange for receiving the services, entity does not have a present obligation to pay until it has received the services. Before the contract is executory, the entity has a combined right and obligation to exchange future salary for future employee services. So that takes care of liabilities and assets. Any doubts on liabilities and assets? Yes. Any doubts? No doubts? Sugapriya, did you understand? Okay, fine. We have seen the definitions of income and expenses. Coming next, what do we mean by recognition and derecognition? Recognition is basically the process of capturing for inclusion in the balance sheet or the statement of P&L any item that meets the definition of one of the elements of financial statements, that is asset, liability, equity, income, or expenses. The amount at which an asset or a liability or equity is recognized in the balance sheet is referred to as its carrying amount, something which we are all fairly conversant with. Recognition links the elements, the balance sheet and the P&L as follows. Opening balance sheet plus P&L plus changes in equity gives you the closing balance sheet. This also we are all familiar with. Recognition criteria, always remember it works on relevance and faithful representation. This is the fundamental characteristics if you recollect. What is derecognition? Derecognition is the removal of all or part of a recognized asset or liability from the balance sheet. Incomes and expenses cannot be derecognized as they are not resources or obligations at a point of time. Dereco normally occurs when items no longer meet the definition of an asset or liability. I lose control of the asset, derecognize. I no longer have an obligation, derecognize the liability. Is it okay? Yes. Sale of goods for cash results in recognition of both income and an expense. So you will recognize the income, that is the sale revenue, and the expense, that is the COGS, that is the cost of goods sold. Okay. So you can go through these questions. As at 31st March, Natasha carried trade receivables of 280 crores. At that date, Natasha entered into a factoring agreement with Samantha Limited, a financial institution, according to which it transferred the trade receivables in exchange for an immediate cash payment of 250 crores. As per the factoring agreement, any shortfall between the amount collected and 250 crores will be reimbursed by Natasha to Samantha Limited. Once the once the trade receivables have been collected, any amounts above 250 crores less interest on this amount will be repaid to Natasha Limited. The directors of Natasha are of the opinion that the trade receivables should be derecognized. Explain the appropriate accounting treatment of this transaction and also evaluate this in the context of the conceptual framework. Yes. What do you guys think? Yeah. Yes. Should we de-recognize? If yes, why? If no, why? Just a minute. Yes. Should I de-recognize it? No. So, Priya, what is your answer? Yes. So this is what we call a factoring with recourse. Okay, this is what we call as a factoring with recourse. Means what? The company which is factoring its trade receivables, it has to pay the, see, this is a factoring with recourse because you can look here. Any shortfall between amount collected and 250 crores will be reimbursed by Natasha to Samantha Limited. Okay, so let us understand what is the transaction. I have Natasha, that is the company that is having the accounts receivable. And I have the factoring company. Factoring company. Now, what Natasha will do is Natasha will give the invoices to the factoring company. Okay. And what Natasha tells is to its accounts receivable, to its trade receivable says, look, when the collections become due, please make the payment to factoring company. Please make the payment to the factoring company. If the accounts receivable, I mean, my trade receivables, make the payment to the factoring company, well and good. But if they do not make the trade receivables to the factor, they do not make the payment to the factoring company, then it is Natasha Limited who has to pay the money back to the factoring company. So, in effect, what is it? In effect, what is it? It is a financing arrangement. If it is a factoring without recourse, then there would not be absolutely anything. Yes, there would not be any such issue. You would straight away take it into your AR derecognition. Here, can I derecognize? Answer is no, because the risk in respect of those ARs not paying remains with Natasha and it does not get shifted onto Samantha, that is the factoring company. And therefore, we shall continue to record it as an accounts receivable without a derecognition. Without a derecognition, once the accounts receivable pays to them, I can proceed to derecognize my accounts receivable. Are we okay, Sugapriya? Yes. Did we follow? Yeah. So in this case, this is the treatment. You cannot de-recognize because I still have the obligation to pay this amount if my debtors do not pay him. If it was otherwise, where I was not obligated, then I could go ahead and de-recognize my trade receivables. Okay, so that takes care of this one. All right, fine. This one, I would like you to go through this second one. It's just understanding of Ind AS 38 with the conceptual framework in terms of any inconsistencies. So measurement basis for an asset or a liability, you have historical cost or current value. In current value, it is exit value or entry value. Entry value would be the current cost. Exit value would be the fair value or value in use in the case of an asset, or fulfillment value in the case of a liability. What is the basis for selection of this? But what is the factors for selection of measurement basis? Relevance and faithful representation. This is nothing but the qualitative characteristics. Okay, all right. The directors of Hind Limited are particular about usefulness of financial statements. That they have opined that although Ind AS implements a fair value model, they are failing in reflecting the usefulness of the financial statements, as they do not reflect the financial value of the entity. As they do not reflect the financial value of the entity. Discuss the views of the directors as regards the use of fair value in Ind AS and the fact that the Ind AS do not reflect the value of an entity, making special reference to relevant Ind AS and the conceptual framework. Making special reference to Ind AS and the conceptual framework. Well, first of all, there is lot of fair value discussions. There is lot of fair value discussions, but it is not necessary that we use fair value at each and every number that we disclose. Like for example, assets, that is property, plant and equipment. Many times the historical cost is the best representative because I have put that asset to use and I'm carrying on operations out of it. My intention is never to sell that asset. And therefore, the fair value measurement notably is not required for the property, plant and equipment at that point of time. So therefore, it is a mixed measurement system. Your investments in equity, you have to do a fair valuation. There is no option given to that. But for PPE, you have an option. So it is a mixed measurement system. Now, coming to fair value, we have highlighted the points. What is also important to notice, yes, financial statements do not give the value of the entity. They are historical financial statements and they are not intended to reflect the aggregate value, because aggregate value is a notion, it is a calculation the way the people perceive the value to be. Our attempt to put certain items in the Ind AS, in the financials, may not be wholly supported by Ind AS, and therefore it is not necessary for us to give the financial value in the financial statements. That's what we will have to tell. Okay, all right. On similar lines, you have this question where we talk about mixed measurement approach. So here they say that the company is having particular reservations that mixed measurement is merely inconsistency. So that is not the way you should view it, because some items make sense to record at historical cost only, and some items it makes sense to do the fair valuation only, which is what has been prescribed. Okay, so you can read to that. All right. Now, factors specific to initial measurement, transaction on market terms using currency or exchange of asset or liability, and transactions not on market terms. So this is okay. All right, just go through this. All right. Presentation and disclosures. A balance is needed between giving entities the flexibility to provide relevant information that faithfully represents assets, liabilities, equities, income, and expenses, requiring comparable information from period to period and in a single reporting period across entities. Effective presentation and disclosure is achieved by proper classification and aggregation. You need not give line item wise details. In the profit and loss account, small expenses are aggregated and put into as miscellaneous expenses. So similar treatment has to be carried out. Okay. All right. Fine. So this particular question deals with categorization as held for sale. So you can go through this. Everest is a listed company having investments in various subsidiaries. In its annual financial statements for the year ending X2 and X3, Everest classified Kanchenjunga, a subsidiary, as held for sale, presented it as a discontinued operation. On 1st November, the shareholders had authorized the management to sell all of its holding in Kanchenjunga within the year. In the year to March X2, the management made a public announcement to sell but did not actively try to sell the subsidiary as it was still operational. Certain organizational changes were made by Everest Limited during the year, thereby resulting in additional activities being transferred to Kanchenjunga Limited. Additionally, during the year ending March X3, there have been draft agreements and some correspondence with investment bankers, which showed in principle only that Kanchenjunga was still for sale. Discuss whether classification of Kanchenjunga as held for sale and its presentation as a discontinued operation continues to remain appropriate by referring to the principles of the relevant Ind AS and evaluating the treatment in the context of the conceptual framework for financial reporting. Yes, tell me, what is your observation? What is your observation? Yes. Am I meeting the requirements of Ind AS 105? Ind AS 105 has given 5 points for sale to be highly probable. That is, they must be committed to a plan to sell the asset, active program to locate a buyer, and complete the plan must have been initiated, actively marketed for sale at a reasonable price. Sale should be expected to qualify for recognition within 1 year, unlikely that changes made to the plan will be withdrawn. So therefore, this ends up, these 5 conditions you meet, you can classify it as held for sale. So none of these factors exist. And furthermore, they are saying that the changes are a good indicator that Kanchenjunga was not available for sale. And furthermore, mere agreements with investors, etc., do not point out that you are making an active decision to sell it, an active effort to sell it. And therefore, it is not appropriate to recognize it as a discontinued operation. Is it okay? Yes. So that is how you are going to treat it. That is how you are going to treat it. Is it okay? Yes. So the key point is now coming to the conceptual framework. Coming to the conceptual framework, talks about relevance and faithful representation. Now, when we talk about relevance and faithful representation, sir, this subsidiary is meant for sale. Ideally, I should show it as held for sale. Sir, even if I don't meet the criteria, I should have shown it as held for sale because it will help my users of financial statements to take decisions. When they know that one subsidiary is shutting down, closing out, inflows won't happen, they need to be aware of it. But what the Ind AS 105 standard tells us is those 5 conditions need to be met. So the conditions in the standard is more strict than what is prescribed in the conceptual framework, and therefore Ind AS prevails over the conceptual framework, and therefore we follow the Ind AS. Are we okay with this? Yes, are we okay with this? Any doubts? So conflict between, Sugapriya, did you follow? Between Ind AS 105 and framework. Ind AS requirements prevail. Ind AS requirements prevail. Okay, so that takes care of illustration 4. Okay. So last concept, concepts of capital, you have financial concept, that is money invested, net assets or equity, and physical concept, that is operating capability, productive capacity. Okay. So when we talk about money invested, it could be 12,000. How many, what is the capital balance at the end, what you have withdrawn, similar to what we have been doing. Okay, and how much you have withdrawn, what is the closing balance. The differential will be what is the earning that you have done. Okay, so based on that, you can do this for your homework. And you have similar question here also. Yes, you can do that. Now, basis that, you are also having physical capital maintenance, which happens on the operating capability, which happens on the operating capabilities. Okay, so that's all that is there in concepts pertaining to finance, I mean financial capital and physical capital, where one is related to your monetary or purchasing power and the other is related to your operating capabilities. Okay, just go through this in your study module. I think that fairly covers the entire topic. Okay, yeah. So under financial capital maintenance, you are expected to have earned the profit only if your closing capital after all distributions, etc., is higher than the opening capital, is higher than the opening capital. Owner's contribution, owner's distribution, leaving all of that, when your closing is higher than the opening, it means you have made a profit. When we talk about physical capital maintenance, only when the operative capacity or productive capacity of the entity at the end exceeds the capacity that was there at the beginning, exceeds the capacity that was there at the beginning. That is the meaning of concepts of capital maintenance. Of concepts of capital maintenance. Are we okay with this? Yes. Did you understand? Any doubts? No doubts? Yes. So that concludes framework also. So now we shall look into any doubts or queries that you people are having. Please do let me know. Anything that you would like to discuss. Any doubts, any queries? You would have gone through the sessions. Yes. So in that, if you have any doubts relating to these two topics, please let me know so we can address them. Yes. Anything? Sugapriya, anything you'd like to add? Manish. See, the weightage of this topic, typically you can expect about 6 to 8 marks because it contains the fundamentals for financial reporting. Okay, so any question between 6 to 8 marks you can expect. And no, it's not so regular because the syllabus is so vast that you do have a lot of other topics which are more critical than this. So see, the whole purpose behind having this particular topic is to understand what is the ground for us to do the accounting, what is the ground for us to do the accounting, and what are the rules that we need to follow. we are focused more in detail on the IND-AS side, because ultimately you saw in framework IND-AS overrides the conceptual framework, which is why we are focusing more on the Indian accounting standards. But there could be certain treatments which IND-AS also is silent. So at that point of time, it is this particular framework that will provide guidance as to how to do the accounting. Okay, all right, fine. Okay, all right. That is a good feedback for the institute. So that is great. So you can be thankful to the Board of Studies for this initiative. Okay. Yeah. So, yeah, so by and large, we are done. Nothing else from my side, at least. If you have any doubts or anything, please let me know. This happens to be the last session, I suppose, in terms of the November 2024 attempt. So, are you guys appearing for the November exam? Manish, Sugapriya? Okay, sure, sure. Yes, you can. I believe, in fact, that what was the methodology adopted this time was that the recorded sessions were shared, and thereafter we had a discussion with the faculties online. Okay, so you could do that, no problem. Manish, anything else? Is that it? Hmm. Okay, yet to qualify set B. Okay, fine, fine. Okay. So, that concludes our brief interactions that we had over the last 5, 6 sessions. Yes. So, I hope the topics were fruitfully discussed and we had a good knowledge sharing for all of you. So, you guys are expected to answer shortly. So, wish you all the very best. I think. Uh, that's all from my end. We are all done with your course, whatever is required. So wish you all the very best and do study hard. For any issues, you are free to reach out to the institute and we will help you with any query that you are having on the particular topic as you do the revision in the coming months. Okay.